Welcome to the Lend Academy podcast, episode number 75. This is your host, Peter Renton, founder of Lend Academy. Today on the show, I'm delighted to welcome Mike Baliman. He is the creator of the London Fintech podcast, and he has been around financial services in London his entire career. And he has a very popular podcast today, so I wanted to get on the show to talk about what's going on in fintech in the UK, in particular with a focus on the peer-to-peer lending sector. And we talk about Brexit, we talk about risk, one of Mike's favorite topics. We talk about some of the different models peer-to-peer lending platforms have there. We talk about corporate governance and, of course, the FCA and regulation. It was a fascinating conversation. Hope you enjoy the show. Welcome to the podcast, Mike.
Thank you very much, Peter. It's my pleasure.
Okay, so let's just get started. Give people a little bit of an introduction about yourself and how you came to start London Fintech Podcast.
I've been in the city for over 30 years now. I actually started my life in a tech startup in Bath, which was a very formative experience. It was filmed by three managing directors. In those days, there wasn't much capital around. They second mortgaged their houses, so they really cared about results. And then I was a merchant banker for 13 years. I ran global fixed interest fund management at Claremont Benson, which was the premier blue chip merchant bank at the time. And I was the first head of risk in the city in 1992 when it didn't exist, and all that managed the city was the governor and his famous eyebrows. In 1998, I escaped to become independent. I'm still independent now. And fast forwarding all the interesting things I did in the middle, I started the podcast some 2 odd years ago.
So what prompted you to start it?
I woke up at 3 o'clock in the morning. This is absolutely a true story. I woke up at 3 o'clock in the morning. I thought, oh, there isn't a podcast on fintech. Oh, I'll do one. And for some reason, despite all my age and wisdom, I forgot that you never actually do what you think of at 3 or 4 o'clock in the morning. So I started one.
Well, it seems to be going. It seems to be going quite well for you. Certainly, you have. I mean, I've listened to many of your podcasts, and I think you are really filling a gap in the market for sure, and I think you do a great job.
Well, I think the best ones, Peter, as you will have heard, are the ones where you've guest starred yourself. So they're my favourite.
Right. So. Well, of course you say that. Yes. So anyway, let's just get launched right into it, and I want to start with the elephant of the room that everyone, I think, in the US is obsessed with, probably more than the UK. It seems like. And that is Brexit. You know, we're about 3 months removed from the surprising decision that happened for Britain that's going to exit the European Union. So can you give us your perspective on what you're hearing and what we are going to see out of the British economy, at least in the near term?
Well, I think in terms of setting the picture on that, I think the most important thing to be communicated to anybody who literally wasn't here and didn't have to put up with months of propaganda and media coverage, is that it was extremely divisive. There really was a large divide, emotionally as well as intellectually, between those people who voted in and those people who voted out. In terms of doing Brexit, I did a Brexit special with Giles Andrews, who I know you know well and you've had on your podcast, as pretty much the father of peer-to-peer in about 2005 and Zopa. And he was quite emotive in terms of being a Remainer, which most people inside the M25 in London were Remainers. So the divisive campaign was a bit of a challenge, and you will find it relatively hard to get neutral assessments of the whole thing, in that either people say yes, or we won, or yes, we lost and we're going to contest the outcome. Right. I think that in terms of macroeconomically, Boris Johnson, the former Mayor of London, now the Foreign Secretary, was quite right when he spoke about the government's Project Fear. So the government, from the Prime Minister and Chancellor in particular, but also enlisting the allegedly neutral Governor of the Bank of England and big corporate bosses, all went out of their way to say it would be a complete disaster for the country if we left. George Osborne famously said there'd be a punishment budget where he's going to put up our taxes and cut pensions and things like that. And later admitted that actually that didn't exist, and rather like all the sort of war criminals we've had running the government so recently, he wasn't locked up in the Tower of London either. So it really was Project Fear, and against that background, even people who voted out were worried about what's happened, what was going to happen. What has happened is actually the economy has been relatively robust and things are going relatively well. So actually there was much hysteria on both sides. There was a committee in Parliament that censored both the in and the out campaigns saying basically both lied through their teeth. And I know you guys are in a presidential campaign at the moment, so you're also used to the fact that everything politicians say isn't necessarily 100% true.
Yes,
we are now actually calming down, and in practice, we are still part of the EU. I'm revising at the moment, editing a podcast today on the PSD2, the Payment Systems Directive that's coming out of Europe about access to payments and open banking and open APIs and all these things which are exciting people over here. And on the current timescale, we're still going to be in Europe when that directive comes out, so we're going to have to comply with it. So for the near term, we're still part of Europe. For the medium term, it's not actually clear where we're going to get to. So the medium term remains unclear, but surprise, surprise, life goes on. Even the people who are upset at leaving, well, you get on with your life after a while.
Right, yeah. So it sounds like the medium term is unknown. It could be bad. There could be a bad recession. There could be people suddenly making Berlin or Dublin their hub for Europe, particularly when it comes to international companies. But I guess from your perspective, you would say that it's too early to say what the impact's going to be.
I think I, and many others, Giles is a good example, for example, are very optimistic because Britain has had literally centuries and centuries of going it alone. I remember as a schoolboy, about the age of 14 or 15, basically having had British and European history summed up for me, saying that over the centuries, Britain has always had one foot in Europe and one foot on its own island. And it's exactly the same at the moment. So that's how the vote went. One foot was to be continental European, as it were, and the other not. So I think we've got good connections with your former country, Australia, and the whole Commonwealth and around the world. And I think that even in the extreme cases where we're not too much part of the sort of the EC project, there's a good scenario. The other thing which complicates it is in terms of financial services as a whole, not just looking at fintech or even P2P within that, all the indications are at the moment that, surprise, surprise, financial services firm want this thing called passporting, which basically allows them to do financial services business around Europe. In order to do passporting, ironically, or not as the case may be, you have to follow all the EC legislation. So we can get, in the context of financial services, a situation where we voted to go out of the EC, but actually, by choice, we end up having to implement all of their rules anyway.
Right. So for financial services, there may actually be not a huge change. That's fascinating. Okay, I want to move on to talking a little bit about peer-to-peer lending. I know you cover all of fintech, not just peer-to-peer lending. Although I tend to see there's a good chunk of your episodes are focused on the space. But so in the context of of Brexit and other things that are happening in the UK, how is the UK fintech sector doing, and what can peer-to-peer lending learn from the rest of fintech in the UK?
There's some large questions. I think that in terms of fintech as a whole in the UK, it's rather like a tapestry with a number of threads being woven together. So fintech in the UK and perhaps worldwide would not be what it is without 2008. Because 2008, as far as the policymakers were concerned, gave the policymakers a clear agenda to drive as much as possible competition away from the banks. And a good example of that in a non-peer-to-peer sector is in payments. So in the UK, we've had something called the PSR, the Payment Systems Regulator, set up, Hannah Nixon, who came from something like electricity or something like that. But she's an economic regulator, so her purpose is to increase competition. So both the UK Payment Services Regulator, but also this directive I referred to earlier called PSD2 in Europe, are about opening access to payments directly for fintechs without being banks. Mm-hmm. So that shift affects us all around the world, and 2008 was 2008. It caused a lot of popular anger. In particular, it caused a lot of popular anger here, where, for the sake of argument, the banks were, quotes, bailed out, given lots of money, and then banks being banks, a lot of them then just paid themselves big bonuses using the money. So
right.
There are lots of logical arguments why the incumbents may well win this one, but actually there's still a lot of popular disquiet and people who say, oh yes, let's try a new app-only bank, for example, because it isn't Bank XYZ, my current bank. So I think that's the sort of the context of fintech. A lot of that is carrying on regardless. A lot of it is really just, as you know, the impact of digital upon the financial services industry. Digital hit media, for example, quite some time ago, but it's now only hitting FS. Mm-hmm. So you've got all these things in the pod. In terms of what peer-to-peer can learn from other sectors, I think peer-to-peer has had pretty much its own trajectory, as have the other ones, payments or digital currencies or investment or robo-advisors, as people in the States tend to call it. In terms of the peer-to-peer sector, I think the macro picture is very simply, and this is obviously a sort of British perspective that quotes, we invented it, and then as usual, America goes off and does it sort of bigger and better. So you've had the first IPOs and all that kind of stuff and got much greater volumes, but it started here in 2005. And then pretty much we started trying to catch up with the people who've overtaken. So the zeitgeist, the spirit of the whole thing, about 18 months ago, was very much around, the big ones posturing about, IPOs, and we're preparing ourselves for IPO maybe later this year, which some of them said. Privately, of course, as you might imagine, some of the founders were rubbing their hands in glee and thinking, we could be worth £250 million by Christmas. Wow, wouldn't that be fantastic? And £250 million is a round of drinks where you come from. But over here, it's seen as an infinite sum of money. And I say that because there are several hedge fund managers who paid $1 billion per annum. So there was this kind of lust for growth, and one or two of the platforms, without naming names, made some pretty injudicious calls in late 2014, early 2015, which is hitting their credit performance. And of course, what's happened as a result, again, of shadowing pretty much what's going on in the States, is with the reduction of institutional flows and the various crises that you've covered extremely well at your end on your podcast and on your blog material, the same kind of thing has happened in the UK. Inflows have dried up. And actually, as I forecast in January for fintech as a whole in 2016 in London, this is pretty much the year of a shakeout. So we've seen a peer-to-peer, notably Funding Night, going bust, not for reasons of fraud and like TrustBuddy, but just basically because it went bust, to cut a very long story short. So at the moment, it's slightly in the doldrums. It's a little bit becalmed, and it really, I think, needs to refocus over here, not on externalities such as are we floated, are we not floated, but really what actually is our unique added value that we do better than anybody else, and then push ahead finding customers who want that.
Mm-hmm. Yeah, it makes perfect sense. So I want to talk about risk, which I know is one of your favorite topics. You chaired a panel last year's Lender on risk, but I wanted to get your perspective. Are investors today, investors in peer-to-peer lending today, do you think they're being adequately rewarded for the risks they are taking?
That's a good question. I mean, just to take a little step back, as I say, I was a poacher in the first place. I mean, I managed a lot of money in the 80s, and then I poached a gamekeeper internally in the bank. And in 1992, 1993, when nobody on main boards of banks believed that risk was anything to do with them, the attitude then was that risk is for the little people, the traders on the ground floor kind of thing, not for management. And it took all the changes like Barings Bank going bust for management to start paying attention. You then went through a massive cycle, and this is useful background for the peer-to-peer, of first of all management paying attention, and then IT vendors coming in and selling huge expensive systems that would take forever to implement, to produce a number, the VAR, the value at risk, which said the risk in Citigroup is 5 trillion and the risk in Barclays is 4 trillion, that kind of thing. And then everyone said we've got the answer. It turned out not to be the answer, of course. We then have had, post-2008, vast increase in bureaucratization of regulation. Regulation has actually sort of leapt forwards. And I think this is a journey which I'm slightly concerned that peer-to-peer will go through. I think where peer-to-peer at the moment is very much like the early 90s in banking as a whole, which is actually you have got what you've always had in banking, which is you've got people looking at the quality of the credits that the platform's doing. It doesn't really matter that they're not buying them themselves. I mean, some of them are. The direct lending models do, as you know. But generally in peer-to-peer, you're passing it on to someone else who's buying it. But nevertheless, you've got this kind of quality control end, the underwriting end, and they've always been there. What you're seeing now a little bit more, and as you say, I forecast this in my writing, last year was some of the platforms hiring heads of risk whose mandate went further than just making sure, as it were, they buy good eggs for sale in their shop. What we haven't yet got to is the stage of where banking, especially on trading risk, got to with VAR, with the value at risk. What we haven't got yet is the platforms in the UK or in the US, as far as I've seen, publishing a number saying this is the risk. It's 42, or it's 4.2, or it's 0.42. There's no qualitative assessment, other than in a couple of cases, Funding Circle springs to mind, as does Landbay, where they've done stress tests, which is when they say, OK, if the worst hits the fan, as defined by the Bank of England's worst case, which the banks use, then the portfolio will fall 1, 5, 10, whatever percent. And there's a quantitative number. So I think my most honest answer I can give you as someone with 30 years of risk experience in the city, both in the sort of the incumbents and the new ones, is that a precise answer to that problem awaits the platforms themselves quantifying what they think the risk is. They're not doing that, which, is, as you know, was one of the themes of the 2015 Lend It in Europe. Having said that, as a fag packet, if you're investing in the best quality platforms at the moment, your returns are something like 10 times bank returns, and they're not taking too much risk. So as a fag packet, you're probably okay still.
So I guess what you're really getting at there is that the platforms should stress test, every platform should stress test their portfolio with using the '08 crisis as sort of a benchmark or whatever it is. You said the Bank of England has some sort of benchmarks there. So then people can say, right, the expected return is X. The expected return in another downturn is, Y, and then then investors can make a decision. Is that really what you're saying, is that everyone should be doing that, or is there something more?
I think that's half of it. I certainly don't see why platforms, the biggest of whom, frankly, have got a lot of money, one of the larger UK ones, which is also in the States and Germany, Funding Circle, raised $150 million last year, and informally I'm told they haven't spent it all yet. So they have significant resources, and they're already doing the stress tests. So I don't see why, putting it the other way around, why the platforms should not both do the stress tests and publish them, as in a way they're just brokers selling stuff on. So that is absolutely one side of the coin, which would allow you, and I know you've spoken about your investments for many years now, which would allow you, Peter, to look at your portfolio and go, okay, if according to the Federal Reserve test, which it gives the banks, if the worst happens, whatever that worst is defined as, I will lose 1%, 5%, 10% of my portfolio. And then you, as an individual investor with your individual portfolio, will know. That's one side of the coin. The other flip side of the coin, coming back to how banks use VaR and stress tests, is not the extreme conditions, is not sort of what happens every 5 years or 10 years, but it is much more like day-to-day volatility. If you put some money in the New York Stock Exchange and you diversify it, then you've got a reasonable idea that on a bad day you might lose 1 or 2%, that kind of things, because let's say you're doing relatively short-term investment, you may never actually hit the stress test scenarios in terms of your portfolio.
Sure. So I want to talk about some of the different models that we have in the UK and Europe, and particularly in the UK, there seems to be several of the leading companies have provision funds or safeguard funds or whatever you want to call it, that are basically going to take the losses and preserve the principal of investors, supposedly, and then others choose not to do that and say, you know what, you're on your own. If if defaults happen, you're going to lose principal. So do you have a preference, or I'm interested in your thoughts on both those two different kinds of models?
Yes, and I think it's true to say that certainly from my perspective, again, just to simplify the overall picture, which is always more complex than the simplification, the only two firms who really lead big time on provision funds are Zopa and RateSetter, and they have different models that I'll come on to, as you've covered in your shows, what I tend to call hard fail, what I tend to call soft fail provision funds. I'll come back to those. One of the motivations we had over here, which may not have applied in the States, hence the difference, is that there was a problem over here of not being able to offset your capital losses against your income in your portfolio. So let's say, for the sake of argument, I had 10 loans in my portfolio and they were all yielding, 10%, and one of them went bust. I would have to pay income tax on, for the sake of argument, whatever, 10%, but I'd only then have a capital gains loss of 10%, which I couldn't offset it. So it was taxation reasons that drove it,
Yep.
And I know that was certainly the thinking of Zopa, and that is slowly changing. So that need is going away. And if you look at what Zopa's doing, it's already introduced various products where you don't have to go through their provision fund, so they're somewhat backing away from it. In terms of the two models of provision fund, RateSetter's model is what I call a hard fail model. So it's got the provision fund set up. If anybody's individual investments are impaired, and I think off the top of my head no one's, quote, lost a penny with RateSetter yet, the provision fund will make them good. It will pay the interest they should be getting in the capital bank. And that's all fine, and it's worked brilliantly. The problem with the hard fail model, as RateSetter have it, and the FT Alphaville column has covered this quite a lot in depth this year, as well as the more sort of in-trade press. The problem with the hard fail model is that when the provision fund runs out in RateSetter, everyone's assets are pooled. Everyone's assets are pooled, and it basically turns into a mutual fund, which is then wound down. Mm-hmm. There's suddenly a sea change. It doesn't matter which 10 investments you've got, if even you know what they are. Your bad apples get pooled with my good apples, and we're all in the same boat together. Personally, I think this is a flawed model because you're always on the edge of a precipice. You're always on the edge of this digital change where you stop being one thing, you stop being another. Soft fail models, such as Zopa's, basically what happens is that when their provision fund runs out, they say, oh, sorry, Peter, we've been subsidising your losses the last 3 years on some of your loans, but you know what, our provision funds run out, we can't subsidise anymore, so you will be taking the losses. But the platform continues as a platform. I think, coming back to the risk point as a whole, the other problem with provision funds is they obfuscate what the risk really is.
Right.
The good thing with marketplace models, be it Lending Club or be it Funding Circle, is that you can look at C2s and you can look at the data around C2s as you've done in the past and all that kind of stuff, and you can make more quantitative assessments yourself, even if they're not making it. When it's a provision fund, it's a black box. And in insurance, going back to various sectors and what they can learn from it, in insurance firms, the vastest ones in the world, you're not allowed to say, oh, this is what our insurance fund needs to be, and we've decided, and it's the right number honest. You have to get external auditors to come in and audit and tell you what the number is. So again, there's a number of conflicts in this model. So it's really rather problematic, I think I'd say.
Sure. Okay, so I want to talk a little bit about corporate governance. On a recent podcast, you interviewed Jeff Miller. It was an excellent discussion about what's going on with corporate governance or the lack thereof. And I know you're actually moderating a panel on this topic at Lender Europe. So can you give us a little bit of a preview of your thoughts on corporate governance when it applied to the peer-to-peer lending sector?
Yes, as you say, it was an excellent one, and you're a podcaster yourself, so you may have correlated the sort of feedback you get with the episodes, and I've always found that the excellent podcasts are the one where I say very little at all, and my guest dominates the conversation, and vice versa, perhaps. But in the case of Jeff, as you know well, Jeff, I think it's true to say, has sat on more boards of more peer-to-peers than any man in the entire world. So he really knows of what he speaks. He's really been on his hands and knees at the coalface, and he's been on both sides of boardroom difficulties in terms of having to move people on, in terms of having been moved on himself. So he really comes at it with a great depth of experience, not just theory. I think if we zoom up again and situate this in FS as a whole, I think that we've seen over the last 30 years a development of corporate governance, a massive development of corporate governance in the usual bureaucratisation way. Originally, it's a bit like Goldilocks, the porridge too cold or the porridge too hot. Originally, the porridge was too cold. So when I joined Clark Benson in 1985, pretty much the main board was made up of the executive management and friends of the family and sort of soft, tame clients who wouldn't really particularly disagree with the board. And that model didn't have much independence, and that model was partly responsible for things like bearings blowing up because there was never anybody on the board that questioned what was going on in sufficient detail. So the pendulum was on that side, if you like mixing my metaphors. The pendulum, of course, in the bureaucratisation that we see has gone massively the other direction. So all those people who are far smarter than me and stayed in existing FS rather than covering this new exciting sector are now on boards of banks, insurance companies, you name it. And a lot of them, it's just a nightmare. I mean, you get paid loads of money, but you sit there and you sort of have to flick through 6 inches worth of paperwork, which is all PC box ticking. And as we've seen with banks like HSBC, which have been fined humongous sums of money, or rather their shareholders have been fined humongous sums of money, even to the extent that the Treasury Select Committee has called some of them in. Nobody's ever responsible for anything. So the extremes are pretty minimal corporate governments, minimal to no corporate governments, or massive bureaucratisation where everyone's following a rule book and no one's ever responsible for anything. Where we need to get to in peer-to-peer and in fintech as a whole is, going back to Goldilocks, the porridge being not too hot and not too cold.
So then what do you think that the peer-to-peer lending platforms are doing well today? I mean, we've covered already some things that you think that where they need to improve, but what are they doing well?
That's a good question. I think my hesitation.
Surely there's something, Mike.
Yeah, exactly. Right. Can I come back to you on that one tomorrow? Just press the pause on the recorder. Well, I think that the best peer-to-peers, because obviously, we're talking about dozens and dozens and dozens and dozens, the best peer-to-peers are successfully transitioning from being startups to scale-ups. They are robust firms with robust processes, good digital front ends which work, and good marketing and looking after things. So again, going back to objective advice, Zopa tends to get awards almost every year, as far as I can see, on customer service. Great customer service. So they are looking after their customers very well. They have remunerated their clients very well. Risk is all about the future, the past, whether it's sort of horse races or baseball. We know what the results are. And certainly historically, if you diversified your portfolio, as you know well yourself, Peter, if you diversified your portfolio in the last 5 years in peer-to-peers, the best peer-to-peers in the UK, you would have, for the sake of argument, made 10 times bank cash or 5 times bank cash. So they have provided great investments in the past. They've gone through this big phase change from startups to scale-ups, and some of them are quality businesses. I think that the challenge for them at the moment is, how do you go from being a scale-up to a growth company?
Mm-hmm. Right. No, that makes sense. And that's really where, that's where the industry is, I feel like, right now, particularly in the UK, where, there's no company that you could call themselves a big business yet, but some of them are on their way. And, I think this, which sort of segues into my next question about regulation, because, we've got, the FCA has been lauded throughout the world as have really done a decent job in regulating an industry and not stifling it and encouraging competition. And it seems like the FCA may be changing their perspective. I mean, we know they're going back and doing visits with some of the platforms now. I mean, what are you hearing about, the FCA and about from the platforms? Are there regulatory changes coming?
So the big regulatory change was a year ago. All the peer-to-peers, as you know, had to apply to be regulated. Mm-hmm. I think the main thing that I can tell you as an insider on the circuit is, like many things in life, what you read in the media is not reality and can be very different from reality. So certainly I read the same kind of materials as you, and I've seen lots of praise for how wonderful the FCA is and how brilliant the regulator is and how it's a model for the whole world, and et cetera, et cetera, et cetera. Now, how much that is truth and how much that is propaganda, I shall leave that as an exercise for the listener. Suffice it to say that a number of people I've read quoted in the mainstream medias or even in the industry media as saying, "Oh, the FCA is wonderful. The FCA is wonderful." You talk to them in private over a beer, you get a very different story.
Right.
Right. So, for example, just to pick up one particular area, this regulation process started last year. I'm thinking of one example of a firm that's got less than 20 people in office. They had one of the big four accountancy practices in there 3 months. For 3 months, basically filling in the forms of regulation. A year later, they're still not regulated. I'd like that kind of job, really, where you can take such timescales. There's a challenge because of this explosive growth of regulation around the world. There's a challenge which goes back to the old Latin phrase about quis custodiet custos ipsos, who's going to guard the guards, who regulates the regulators. Mm-hmm. So where a regulator is performing well or not so well, who is actually regulating that? And there's a lot of frustration in the industry around the regulation of that. The other one is the Independent Finance ISA, right, which basically is a tax-sheltered savings vehicle over here. There was lots of worries a year ago that on the 1st of April there'll suddenly be trillions of dollars or trillions of pounds flooding into peer-to-peers. How will they handle it? Well, actually, it's really sort of limped off the start because, quotes, the regulator's been quite slow. The other context in the regulator is that, like many of these things, it gets politicized in the modern world, and there have been sort of changes of heads of the regulator and various noises made by MPs, and notably Adair Turner, who I know you've got coming to give an interesting talk at Lendit 2016 in Europe, who was quoted, I believe, slightly out of context and slightly offhand, saying, this is going to be the biggest crisis since the last one, to which my retort has always been, if every cent or every penny in the UK that's invested in peer-to-peer disappeared overnight, a few people would be pretty upset, but it would be macroeconomically insignificant.
Right. Yes, it will. But, to his point, I mean, I know that he's been quoted, pretty much every negative article mentions that as a supporting quote for their argument. But to his point, I mean, it's that is true today, but obviously if the growth trajectory keeps going in 5 or 10 years' time, while it wouldn't have the systemic risk of a Lloyd's or or an HSBC, going out of business, it would, it certainly wouldn't be hurting. It would hurt a lot more. So, but I just want to circle back onto that innovative finance ISA, because it seems like that is something that, I remember talking to the platforms in January and February saying, oh yeah, we hope to be done by March. And here we are in September, and the top platforms still have not been approved for this ISA. So what's going on there? Why is it just the regulator being inundated? I mean, minor platforms have been approved, but the big guys haven't. It just seems strange to me.
Yes, it's an interesting question. As I say, it is an anomaly. And in terms of press releases that go around the world saying, the UK regulations are model for everyone else, I doubt that other countries would want to model 1 year on something that's relatively straightforward like that.
Yes.
I mean, the honest answer is that and I'm sure you have as well, have heard a variety of insider gossip as to why this is happening, whether it's the regulator or whether some of the firms are holding out or playing hardball, or exactly as happens in every regulated sector in the world, whether it's telecoms or electricity or oil and gas or whatever, whether it's just part of a more of a maturing of the relationship between an industry and its regulator, where there's a bit of push and shove on both sides and eventually some agreement is reached to. But I think all that I've heard, to be honest, is kind of tittle-tattle at this stage, so I wouldn't want to report it as facts. I think the main thing is that it does all rather fit into this 2016 zeitgeist of an industry that's slightly in the doldrums at the moment and really needs to sort of get out of this phase and start moving forward in whichever direction it sees its future as lying.
Mm-hmm, mm-hmm. Okay, well, we're just about out of time, so I've got to let you go. But just before we do, I know you're focusing on more than just the peer-to-peer lending industry. So what else is catching your attention today? Well,
I think the interesting thing for me is coming across undiscovered gems. It's a bit like rummaging through antique stores. Occasionally you find something, oh, wow. And I had a podcast myself recently, actually I think it's the one before last, which was with a firm called Smart Pension, who I'd never come across, but I was introduced to. And this is absolutely phenomenal guy called Will Wynn. Basically, he set up less than 2 years ago. In the UK, like many countries in the world, and I think actually we copied it from Australia, we have this thing now which is mandatory called auto-enrolment workplace pension, which means that any employer in the UK pretty much by next year has to set up a pension scheme for his employees. The employees can opt out of it, but they're automatically enrolled in it. And we'll set this up less than 2 years ago against the government as competition. The government allows itself and its own rules to be more expensive than the competition, which is nice, isn't it? And the government sponsors its own player to the tune of £80 million losses per annum. So you imagine from fintech perspective competing against that. Well, in Smart Pension's case, they have got 75,000 clients in less than 2 years.
Interesting.
It's absolutely phenomenal. And in his spare time in a previous incarnation, Will was working for eBay and he had a good idea and he said to his boss, I've got this good idea. And the boss says, look, you've got too much that I've asked you to do. You don't have time for this. You want to do it in your spare time, you can. So he went and did his spare time project. His spare time project was eBay for charity, which he then set up and got it approved. And that's now raised £100 million. So I think the thing that excites me is actually discovering phenomenal companies like that who are really an exemplar for every entrepreneur in the world, not just in fintech or not just in peer-to-peer. Another company I came across recently, founded by some ex-Merrill's people in the early 2000s called Synchron, got 6,000 staff worldwide. They have not raised any external capital. In the last 15 years, they've gone from zero to $600 million per annum revenue. That's phenomenal, and they're going to win the show later in the year. So I think that's what really excites me, is that it doesn't matter what the weather, what the economic climate, as you know yourself, Peter, having been an entrepreneur in the past, there are some people who can just put on a phenomenal song and dance.
Yes, indeed. Well, on that note, I'm going to have to let you go, but I really appreciate your time today, Mike.
Thank you, Peter, and I really appreciate your podcast. Whenever I get the chance, I always listen to them, and it's nice to hear a professional podcaster such as yourself.
Okay. Well, thanks very much, Mike. We'll talk to you soon. Bye.
Have a good day. Bye.
As I said, Mike will be at Lend It Europe in a couple of weeks talking about corporate governance, and just allow me to give just a few moments of a plug to Lend It Europe. If you go to lendit.com, you can register right now. It's October 10th and 11th in London at the Intercontinental Hotel at the O2. It'll be the largest gathering of peer-to-peer lending platforms and the industry ever in Europe, and I will be there. And if you attend, please come up and say hi. On that note, I'll sign off. I very much appreciate you listening, and I'll catch you next time. Bye.